All right, let's talk money. You've got some cash saved up. Nice. But it's just sitting there, right? Losing a little bit of its power every single day thanks to inflation. You know you need to invest it to make it grow. But then you hit the big question. How? You hear people talking about stocks, picking the next big thing, the next Tesla, the next Amazon. Sounds exciting, right? Getting in on the ground floor and riding it all the way to the moon. That's the dream of picking individual stocks. But then you hear the other side. The slow and steady, don't put all your eggs in one basket crowd. They're talking about index funds. Sounds kind of boring, doesn't it? Like the sensible shoes of the investing world. So, what's the real deal? Is it better to be the stock-picking sniper, hunting for that one perfect company, or the index fund investor, who just buys a little piece of, well, everything? Think about it like this. Buying an individual stock is like betting on a single racehorse. You've done your research. You've checked its stats. You've watched its past races. You love the jockey. If that horse wins, you win big. The payout is huge. That's the thrill. You saw the winner when no one else did. But what happens if that horse stumbles? Or just has a bad day? Well, your money is gone. Poof. All of it. Now, an index fund. That's like betting on asterisk, every single horse asterisk in the race. Just a tiny little bet on each one. You're not going to get that massive, life-changing payout from one horse's surprise victory. But you're also not going to lose everything if one horse trips at the starting gate. As long as most asterisks of the horses finish the race, you're going to come out ahead. You're basically betting on the entire sport of horse racing, not just one animal. That, in a nutshell, is the difference between individual stocks and index funds. Let's break it down. An index fund is a bundle of stocks or bonds designed to mirror a specific market index. The most famous one is the S&P 500. When you buy a share of an S&P 500 index fund, you're not buying one company. You're buying a tiny slice of the 500 largest companies in the US. We're talking Apple, Microsoft, Google, all the big players. Your money is automatically spread out. That's called diversification. And it's your best friend when it comes to managing risk. The beauty of this is its simplicity. You don't have to spend hours researching balance sheets or listening to earnings calls for 500 different companies. The fund does it for you. It's a set it and forget it approach. For most people, this is a fantastic way to build wealth over the long term. The fees are usually super low, and historically, the market as a whole goes up. It's a get-rich-quick scheme. It's a get-rich slowly and reliably plan. Now, let's talk about the sexy stuff. Individual stocks. This is the Wall Street you see in movies. The high-stakes game. And look, people can and do make a fortune this way. If you bought Amazon stock 20 years ago and held on, you're probably doing pretty well right now. But here's the crazy part. Picking winning stocks consistently is incredibly hard. Like, harder than being a professional athlete. Even the pros. The hedge fund managers with their fancy degrees in supercomputers. Even they struggle to beat the market average over the long run. To be a successful stock picker, you need to do a ton of homework. You need to understand the company, its industry, its competition, its management, its debt. The list goes on and on. It's practically a full-time job. And you have to be right, not just about the company, but about the timing. You can find a great company, but if you buy its stock at the wrong price, you could still lose money. And then there's the emotional side. Your favorite stock drops 20% in a day. What do? Do you panic and sell? Do you buy more? It's an emotional roller coaster, and our human brains are wired to make bad decisions when fear and greed take over. So, what's the verdict? For the vast majority of people, index funds are the way to go. It's the simplest, most effective path to long-term wealth for anyone who doesn't want to make investing their life's obsession. You get diversification, low costs, and you get to ride the wave of the entire market. But wait, does that mean you should never asterisk, buy an individual stock? Not necessarily. Here's a hybrid approach some people take. They put the core of their investment portfolio, CI 80 or 90%, into low-cost index funds. That's their foundation, their safety net. Then, with the remaining 10 or 20%, they have a little fun. They use that play money to invest in a few individual companies they truly believe in and have researched thoroughly. This way, you get the best of both worlds. The stable, long-term growth of index funds, and the potential excitement and higher reward of picking a few stocks. If your stock picks go to zero, it's not catastrophic. But if one of them turns out to be a huge winner, well, that's just a nice bonus. Ultimately, the choice is yours. It comes down to your personality, your goals, and how much time you're willing to spend. Do you want to be the scout, searching for that one hidden gem? Or do you want to own the whole mine? There's no single right answer. But for most of us, owning the mine is a much safer bet.